Howdy, y'all. Welcome, Liberty Call. Today is Thursday, November 14th, 2024. Hope you're having a fantastical day in the interwebs. It's a beautiful day here in Colorado. It's a little chilly outside, but it is wonderful. So, sun's out, clear skies, a little too much snow on the ground, but it's going to take a little while to melt. And it's going to be I think Monday's the next cold front comes through. So, we can survive till then. So I'll take the sunny days any day of the week. So hope you're having a good day out there. And looks like our domestic markets were not in the best mood. So before we get into that, I need your help. I need you to give me some thumbs up, a like, share, subscribe, a follow, and press that notification bell. Hey, and also send it over to a friend who might get some value from this or might like listening to an idiot like me talk. Anyways. All righty, Dow Jones was down 0.47%, 207 points, closed at 43,750. S&P 500 down 0.59%, 35 points, closed at 59.49. NASDAQ down 0.63%, 121 points, closed at 19,109. The VIX was up 1.93% today. It's at 14.29. Canada up 0.24. Brazil fairly flat at up 0.03. And Mexico down 0.27. In Europe, lots of green there. Germany was up 1.26%. The UK up 0.51%. France up 1.32%. The Netherlands up 1 1/3. Spain up 1.29%. Italy up 1.93%. Switzerland up 0.73%. And Portugal up 1.27%. In Russia, both exchanges were red today. The MOEX down 2.39%. RTSI down 3.03%. And the overnights, the Nikkei in Japan was down 0.61%. Australia up 0.37%. New Zealand, when it last closed on the 13th, was up 1.96%. In China, the Shanghai was down 1.73%. Shenzhen Component down 2.83%. China A50 down 1% even. DJ Shanghai down 1.95%. Hang Seng down 1.96%. And the Taiwan weighted down 0.63%. So looks like Asia and America, not so good. Western Europe, not a bad day. So, all right. Let's jump over to the market recap for today. U.S. stocks fall as Powell suggests Fed doesn't need to be in a hurry to cut rates. Who's been saying stuff like that? Me. I've been saying that. Well, I've been saying we shouldn't have been cutting rates at all. But, the election's over. Hang on a second. I got goo in my eyes or something. All right. Okay. So as I was saying, we probably should have continued to raise rates, through the summer of 23 into the fall, gotten up to a point of, a neutral point in the economy where spending flattens, unemployment probably starts to tick up a little bit. And, then we get to our neutral point in the in interest rates. And I mean, frankly, I think interest rates should be set by lenders and the like, but, is what it is. All right, let's get into the news. U.S. stocks fell Thursday as Federal Reserve Chair Jerome Powell signaled that the Fed doesn't need to be in a hurry to cut rates and could take a careful approach to monetary policy easing. Federal Reserve Chairman Jerome Powell said Thursday that the economy isn't signaling a need for speed on rate cuts as the recent strength allows the Fed to take a careful approach to monetary policy decisions. Quote, the economy is not sending any signals where we need to be in a hurry to lower rates. The strength we are currently seeing in the economy gives us the ability to approach our decisions carefully, end quote, Powell said in a speech on Thursday. The rate-sensitive 2-year Treasury yield jumped 6 basis points to 4.34%. Data released earlier Thursday showed that U.S. producer prices increased at a faster annual rate than anticipated in October, rising by 2.4% compared to a year ago, up from 1.9% in September and above economist estimates of 2.3%. For the month, the measure came in at 0.2%, accelerating from an upwardly adjusted 0.1% in September and in line with projections. Excluding more volatile items like food and fuel, the reading came back at 0.3% month-on-month in line with estimates. Year over year, the so-called core index moved up by 3.1% compared to expectations of 3%. This follows Wednesday's consumer prices as the headline rate rose slightly year on year, while core inflation remained pinned above 3%. Quote, the PPI report broadly backs the CPI in terms of a slowing in progress on underlying inflationary pressures. For now, though, the outlook for core PCE is soft enough to keep the Fed on track for another rate cut in December, said Kyle Chapman, FX markets analyst at Ballinger Group. In other news, Walt Disney stock jumped 6% after the entertainment giant reported better than anticipated income and revenue for the fourth quarter, bolstered in particular by strength in its key streaming business, which helped power a 14% jump in revenue. Additionally, Cisco Systems stock slipped 2% after the networking equipment manufacturer unveiled a tepid full-year outlook, while reporting a fourth straight quarter of declining revenue. AMD stock traded flat as the chipmaker said it will lay off 4% of its global staff, or around 1,000 positions. Elsewhere, Tapestry stock rose 13%, while Capri cut losses to rise 5% after the two U.S.-based luxury fashion houses called off their merger after the deal was blocked by the Federal Trade Commission. All right, well, the FTC is blocking fancy clothing outlet or wares, so, well, that's unfortunate. All righty, let's get to some data. The October PPI report from First Trust. This was put together by Andrew Opdyke. All right, the Federal Reserve's recent quarter-point rate cut, with another expected in December, hasn't resolved inflationary pressures. October's producer price index rose by 0.2%, driven by core prices, which exclude volatile food and energy components. Excuse you, Jake. Core PPI increased by 0.3% in October and 3.1% year over year, accelerating from 2.2% in October of 23. Services prices led the increase, climbing 0.3% last month and 3.5% annually, with broad-based gains across major categories. While goods prices rose modestly by 0.1% in October, their annual growth is a mere 0.2%. Specific cost increases for steel scrap meats and diesel fuel offset in and a diesel offset in 18.1% drop in liquefied petroleum gas prices. Further back in the supply chain, prices for intermediate processed goods and unprocessed goods grew by 0.5% and 4.1% respectively, though both categories remain down year over year. Key inflation drivers going forward include the services sector, which rebounded post-COVID, and changes in the money supply. The M2 money supply peaked in April of 2022 and remains 2.3% below that level right now, despite rising gradually since October of 23. Insufficient M2 growth could suppress both inflation and economic activity. However, a resurgence in M2 could reignite inflation concerns, raising questions about the Fed's ability to maintain a measured pace of easing without overreacting. On the labor front, initial jobless claims fell by 4,000 to 217,000 last week, while continuing claims declined 11,000 to 1.873 million. These figures suggest job growth is continuing in November, but at a slower pace than earlier in the year. The Fed faces a delicate balance, promoting economic growth while avoiding a resurgence in inflation. Its next moves, particularly concerning monetary policy and rate cuts, will be crucial as inflation risks remain high and labor market growth slows. All right, so it's kind of a mixed bag. Things are still expensive. We really don't see a lot of, we haven't seen any deflation in the economy. And, in some sectors, inflation is still a little bit warm. Last up comes from our buddies over at the Mises Institute of Biden's economic time bomb, a warning to Trump. I feel like I read this article, but I looked back through the last week or so. I didn't see it. So, alrighty. The Biden-Harris administration's neo-Keynesian policies have led to persistent inflation and record levels of debt, prioritizing public spending and government job creation to inflate GDP and employment figures. Over the past 4 years, accumulated inflation has reached 20.5%. Driven solely by excessive government spending and currency printing, not external factors like corporations or supply chain disruptions. Annual federal deficits have ballooned to nearly $2 trillion, despite record tax revenues and a growing economy. Public debt has soared to $36 trillion. A significant portion of job growth, 43,000 new government positions monthly, reflects expansion in the public sector, which accounted for nearly 25,000 of job gains in 2023. Private sector job growth has lagged, with labor force participation and employment to population ratios remaining below pre-2019 levels. Government spending has consistently driven GDP growth, contributing 30% to annualized growth in the third quarter of 2024, while private investment has stagnated. Critics argue that these policies leave the U.S. economy overly dependent on government activity, weakening private sector vitality and long-term stability. The administration's strategy appears aimed at making government spending reductions difficult for future administrations, potentially triggering a recession if cuts occur. Critics liken this approach to policy seen in Greece, Spain, and France, which emphasize public spending at the cost of economic stability. To counteract these challenges, the U.S. must prioritize private sector growth, reduce government spending, and implement pro-growth policies like tax cuts. Although reducing public spending may temporarily lower GDP, it could lead to substantial growth, higher private investment, and a stronger U.S. dollar. Without a shift in economic strategy, the nation risks prolonged stagnation and reduced economic competitiveness. Yeah, I agree. I mean, if you leave the wealth in the hands of the people in the public, the people who make the money in the private sector, they're going to do good things with it. I mean, yeah, they're going to waste it on dumb stuff. Everybody does. I mean, but that's your right. It's your money. When the government takes a third of it, or the federal government takes a third of it and wastes it on, blowing stuff up. I mean, I've talked about this a lot with clients. If we had zero debt, none at all, I mean, maybe just, what got built up during the year and that gets paid off the next. And we were arguing about how to spend the money, left versus right. The lefties want to, give away free stuff to every poor and idiot in the world who can't take care of themselves. And the people on the right want to go blow stuff up on the other side of the planet. Well, now those are kind of mixed now. I mean, you got a lot of lefties who are pro-war, and you got a lot of righties who are, pro-big government because they like their big government jobs. But, if you get rid of that and, people are able to invest in, private business, I think the United States could really take off again. But we have to take the weights off our shoulders, or off, take the backpack off that's got, 100 pounds in it, and, so we can, run freely. So anyways, all right. Well, that's everything that I had to talk about today. If anyone needs anything from me, please go to DSA Financial Group.com. All your financial planning needs can be addressed there. Give me a call. I'd be happy to help you get back on track, or even take you to the depot to get you on the track in the first place. All right. Well, hope everyone has a great night, and I'll talk to you again next time. Adios.